Thank you very much, Owen. You did cut my lunch a bit because I was going to ask the raise the hands question too, but we're just going to have to do it again. You're just going to have to bear with me. So, all right, tonight I'm going to talk about really the importance of portfolio tracking, which is pretty obvious and pretty on the nose given what we do. And I'll do it in two parts. So the first thing I'll do is share some insights from our user base, which is about 100,000 strong. About half that is based here in Australia. So we do have some really interesting data we can now mine and share at events like these. And then I'll get into the KPIs that we think are most important when it comes to tracking your portfolio. You might know some of this, you might think you know some of this, but it's always a good idea, I think, to kind of go back to basics when it comes to this stuff. All right, so first, who are we? What do we do? So Sharesight is a portfolio tracking solution. We allow investors to understand the movements of their share portfolios, so capital gains, losses, the impact of dividends, DRPs, the impact of Forex. You can connect Sharesight to your broker, you can combine accounts, you can run your tax reports, and so forth. And we actually connect to a wide range of fintech apps as well, including the likes of Xero. So we are benefiting from that moat play that you talked about. We're not a broker, we don't provide advice, you can't trade through Sharesight. It's just a software company, and we operate in like a Spotify or Netflix sort of SaaS model. All right, what in the world is going on in financial markets? If you hope to gain some insight on this question from my talk, you're in the wrong place. I'm sorry about that. I'm just a software guy. We don't have an AFSL, so my disclaimer, I'll just repeat exactly what Owen said, and I'll keep our lawyers happy. But truly, if you do look at some of the local headlines and the overseas headlines, it is pretty scary. I grabbed a couple just from the last couple of months, and I just wanted to throw those on the screen to share. So this was from the Morningstar conference back in October. Some of you may have been there. Low rates and explosive returns. The sun is setting on a decade like no other. They were talking about the next great recession, which is pretty terrifying. Aussie loyalty could be hurting our share portfolios. Sorry about that, it's been cut off, but you get the idea. I say we and us, by the way, when I talk about Aussies. I'm an Australian citizen despite my accent, so I promise I'm not an imposter. I just got my passport, actually, so I'm pretty excited about that, given the current political situation in my homeland. So, of course, we're all obsessed with mining companies and banks, right? That's an old one. We're obsessed with dividends, right? Dividends are a dangerous obsession. We're underweight the value of tech. We don't understand tech companies. Even when we grow great tech companies, they tend to uproot and go list themselves on the NASDAQ like Atlassian. Housing collapse, blah, 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 blah. It's going to wreck our economy. Although I do note that house prices in Sydney and Melbourne have just rocketed back up, and they're expected to go even higher. Inverted yield curve suggests that a recession's around the corner, but I note that I think yesterday the U.S. yield curve became uninverted. Anyway, the opposite of that, so I guess maybe a recession isn't around the corner. And finally, just from the end of October, the rumbling sound in U.S. stocks is a return of risk appetite, right? So all things fine, nothing to see here, it's all going to be great. So it's a bit of a whipsaw in terms of those headlines, and I wanted to follow on from those into some data that we've pulled from our database at Sharesight. But before I do that, I did want to put in one more comment. This is from MarketWatch.com, and this is actually a commenter on one of their articles that said, the only thing I've been bullish on this year is Jack and Coke, which, lucky for Chad, Coca-Cola's done quite well. It's returned 17.23% in the last 12 months, so he's onto something there. All right, locally. Aussie investors are performing quite well. So if we do an analysis over a trailing 3-year period, and we look at annualized returns, and we look at some of the top-rated managed funds out there, in this case, Schroeder Aussie Equity and Vanguard Aussie Shares, they have done quite well. So that's 11% and 12% annualized over that 3-year period. And indeed, the category from Morningstar, which would comprise hundreds, if not thousands of funds, has done 10% over that time period as well. Notably here, and I'll come to this again in just a second, that lighter shade of yellow, though, is a representation of how important dividends are to those returns. So some of those big, well-known fund managers are really relying on those dividends to prop up those returns. So just keep that in mind when it comes to your share portfolio as well. If you had allocated some of your assets to industry super funds, you would have done just about as well, if not better. So Q Super Aussie Shares, Australian Super Balanced, 11%. If you had opted for a broad market ETF or perhaps one of our robo-advisor mates who run some of their portfolios based on ETFs, you would have done quite well as well. STW, 13%, that tracks the ASX 200. And the SPY, which tracks the S&P 500, has done 19% over the last 3 years annualized, really on the back of those tech stocks in the States. And then finally, as our kind of proprietary benchmark, we look at self-managed superannuation trustees using Sharesight to track their portfolios, and they have also done 13%, which really mimics the STW, which makes sense given kind of the nature of our client base. So about those dividends, they do remain very important, as I mentioned. What I've done here is I've looked at 5 different ETFs and, again, our SMSF benchmark, and I just looked at the overall importance of dividends to the return. So you can see in this case, that's actually a bit longer, it's almost a 4-year time period now, dividends are responsible for over half of the performance of the STW, right? Compared to the SPY, it falls to 10%, really because American companies don't enjoy franking credit benefits and tech companies don't pay dividends. Vanguard, MSCI International, it's about a third. Same for Vanguard Asia ex-Japan. And then we look at our data set, it jumps back up to about 50%. So mimicking, again, the STW, which makes sense given that these are SMSFs, people are approaching retirement or they're relying on their share portfolio to fund their retirement with those dividends. And finally, I had to go hunting for something that paid or I suppose had relied more on dividend income than anything else. And I did find that, which is Vanguard Aussie High Yield, and a full 62% of that return over almost a 4-year time period is down to dividends. So dividends are super important for Australian investors. And I think this slide does a good job of demonstrating that. All right, and the last data point that I'll talk to is diversification. A lot is made about how Australians are sort of xenophobic in their investing behaviors, their investing patterns. The ATO regularly puts out stats around diversification. Their ATO website's a bit of a mess. If you go there and try to sort of work this out, their asset class breakdowns are they're all over the place. There's shares, there's collectibles, there's non-cash items. It's very hard for me as a retail investor to figure that out. So I took that data and I distilled it down into asset classes that you or I could invest in. And it works out to be, they claim that 1.4% of your typical SMSF portfolio has overseas exposure. When we look at our data as a comparison, that actually jumps to 14%. So you just simply remove the data point. You can imagine, too, that in that black band and that donut chart on the right-hand side, a lot of those Australian-based investments are indeed ETFs and managed funds with overseas mandates. So we reckon that 14% jumps up to about 18 or 19% in terms of international exposure. So it's a much healthier story, we believe, than is reported in the press. Alrighty, so switching gears a little bit here to portfolio tracking. So why is finding a good portfolio tracker so hard? Well, if you think about it this way, nobody really makes money on portfolio tracking and reporting, right? So we've kind of dared to go into this space as a software company, but brokers earn revenue on trading, platforms and wraps charge asset-based fees on cash or assets, right? And they're really the realm of financial planners. You or I can't really just sign up to a wrap or a platform. Registries are paid by listed companies, which explains why their websites are so fun to use for us. Financial advisors, they used to earn revenue on commissions, but of course, that's all changed to fee for service. And they're not in the software space. They're incentivized to provide good advice, holistic advice, and a range of things from portfolios to insurance and so forth. And same with fund managers. They're not software people. They don't really want to give you that level of insight because they want to run money and they want to just do a good job of that and not really build software. So that means that 70% of our clients come to us from a spreadsheet. And this is actually the spreadsheet that started our business. That is portfolio number 00001 in our database. What we found when we started the business was that tracking this stuff manually is a huge pain, right? So updating share prices, tracking dividends, corporate actions, the impact of Forex, and so forth. If you're fancy and you work in the financial services industry and you're an Excel whiz, you can get away with some kind of clever APIs and some sorting and some macros and things like that. But as you might know, over time, a spreadsheet breaks down, the calculations break, and you're sort of screwed. And I'm guilty of this too, because I still run a lot of our finance function at Sharesight in the spreadsheet myself, and I'm desperately holding on to it, even though it's well past time for me to let it go. And if you don't come to us from a spreadsheet as an investor, a lot of people believe that their brokers give them performance as well. We hear this all the time. I was on an ASX roadshow for the last several weeks, and the most common question I get is like, well, why would I need that? I get it from ComSec, right? This is actually my portfolio on ComSec. I blocked out my HIN so you can't steal my identity and copy my average trading history, I suppose. But this is the portfolio tab from that website. And I think this is what people refer to when they think they're getting performance. But it's not. And investors really ought to stop doing this. For one thing, ComSec doesn't give you any time periods or annualization. You're just looking at a total return. They don't do money-weighted returns, which basically sets the opening and the closing value of a portfolio at the same level when doing performance, and that mitigates the impact of cash flows in and out of the portfolio. They don't do benchmarking. Sure, you can look up, ASX 200 or the S&P 500, but that's just a price index. That's not actually an investable alternative as a benchmark for investors. They don't allow consolidation across other brokers. You can bring in chest balances, but if you've ever done that, what you know is your balance goes like this, like this, and like this, and they consider that a return, when in fact you're just adding new assets into their purview. Asset allocation, they do a bit of this. They've gotten actually quite a bit better at this, but it's certainly not to the level of somebody like Morningstar who does their X-ray and their look-through. And what's very important is they don't do dividends, right? So they have no insight over the dividends that you're paid as an investor. That's the realm of the registry. And because of that, you can't do dividend reinvestments as well. When it comes to the share registries, they have the other half of the ledger. So this is actually an investment that I have in Illumina, 354 units. So they know my unit balance, and of course they're responsible for paying me my dividends. But, and I couldn't help doing this, they want to charge me $50 to get 1 year's tax pack, right? Which in this case is literally a holding balance and like 4 dividends, which strikes me as rather expensive. And I won't name and shame, but you've all seen that color scheme before, so you probably know who that is. So where does this leave Pete? That's Pete. Pete's a real client of ours. He's one of our experienced investor cohort. He's a real person. He kind of looks like Martin Scorsese, which is pretty cool. So Pete's kind of stuck in the middle. So he's depending on research houses. He's depending on online brokers, maybe full-service brokers, asset managers, financial advisors. Those businesses may talk to each other, in an institutional capacity, but they're not really serving the needs of Pete from a reporting capacity. So that's kind of where we step in at Sharesight. So key tracking metrics. This is the last component of my presentation tonight. So number one is that annualized performance. And so what I've done here, just to illustrate how different this is and how confusing this can be for investors. On the top here, I have my ComSec portfolio. And again, I'm using Illumina in this case. This is actually 481 units that I own through ComSec. And the bottom is Sharesight. And what I've done is I've imported my broker from my portfolio from my broker into Sharesight. So it's the same starting point data-wise with different calculations. So the green boxes indicate we've got a bit of a match. And I apologize for those of you in the back of the room if you can't see that, but we can probably share these out when we're done. So ComSec shows me that I made a profit of $584 thereabouts. Sharesight shows me $586. So that's basically on the money. The difference there is just whatever share price was used to do that calculation. However, ComSec is showing me a P/L percentage of 113.25. And I think, unfortunately, a lot of investors look at that and they think, hey, I made 113% return on Illumina. I'm a genius. I'm a great investor. But that's not the case. When we import that same transaction into Sharesight, we show performance of 19.43%. And the reason is down to annualization. I've owned Illumina for 6 years, and I've just sat on it. So that really does bring my return back down to earth in that respect. Number two is the impact of dividends. So I mentioned this before. So same scenario. ComSec is showing me, again, that $584 profit, but surprise, surprise, where are the dividends? Sharesight is showing me a return of almost $1,100. So the difference is pretty striking, $583 versus over $1,100. So obviously that has a major impact on our performance. And there you can kind of see that 50% rule that I talked about before when it comes to STW anyway. Just 2B, the impact of dividend reinvesting as well. So what I did here, and sorry that the colors have kind of gotten a bit muted out here, but I went back 10 years in Sharesight and I bought 1,000 CBA shares, and in one portfolio I opted to reinvest, and another I opted not to. So the numbers just kind of top to bottom are pretty expected in terms of total return, annualized return, and so forth. But from a tax and an admin standpoint, this is where things get really out of whack if you're reinvesting dividends and relying on your broker for that information. What we see here is that in the not reinvested scenario, I'm still sitting on 1,000 units, assuming no splits, consolidations, and things like that. But if I had reinvested my dividends, I now have over 1,700 units in the company, and that information is not available to my broker, which also changes my cost base, which you probably can't see there, but it's about $51 in the not reinvested scenario, and it's $59 in the reinvested scenario. So very different in terms of the information I need to give the ATO. So that's why in our software, we actually get those DRP prices, and we treat those as little mini buys along the way. Number 3, the impact of fees. So I worked at Morningstar for about 10 years, so it's good to see Pat Dorsey mentioned there. I did a lot of work with Pat, actually, back in the day. And I worked in kind of their asset allocation and their quant area, which was about as exciting as it sounds. They had me in this like tiny cubicle in Chicago, in the dark, doing these MATLAB simulations. And really what that taught me, and they hammered that into my head, is that the only guaranteed outcome in investing are the fees that we all pay to do it. And in fact, it was Morningstar, to give them credit, a few years ago, who actually said, you know what, fees are the most reliable predictor of a managed fund's performance than anything else, right? So set aside our own research, our own predictive analytics, it's all about the fees. And I'll come back to that in just a sec. Fees are also driving the passive trend. I mean, obviously the proliferation of ETFs for anything, macro strategies, broad market indices and all that is driving that, but ETFs are just so cost effective. They're just money pouring into them. The last thing on fees I'll just say is just watch out for touts of free brokerage. There's a lot of new brokers out there offering free brokerage. We've seen this in the States with the likes of Robinhood. Even Schwab and Fidelity are offering free brokerage now. They're charging money on cash accounts, and they're charging money on Forex transactions. So they will get their pound of flesh. So just watch out for free brokerage. That's a public service announcement from Sharesight. And then last on fees, we did a bit of an analysis on a $500,000 SMSF portfolio. And we did a bundled versus unbundled scenario. So a bundled SMSF is like an old school SMSF. This is what you get from a financial advisor. They set up the company, they put your assets on a platform, he walks down the hall, gets his mate to do the accounting, and so forth. So on a $500,000 portfolio, we calculated the fees there about $13,400, which is actually quite a bit higher than what you see in the Fin and other press outlets, where they talk more about kind of the ongoing accounting costs to run an SMSF. In this case, this factors in platform fees, asset manager fees, and all the rest. The unbundled scenario, it falls to about $3,500. So that's 2.68% of my portfolio gobbled up in fees in the traditional scenario, and only 0.7 in the unbundled scenario. However, if you think about what this means in relation to your expected annual return, and I've used 8% as kind of the historical, let's hope to get 8% on shares sort of benchmark. The fees in the old school SMSF gobble up about 1/3 of your return every year, right? So you're handing back 1/3 of your return back to just the administrators running your SMSF, right? And in the case of the unbundled solution, if you're using cool fintech products like Zero or Sharesight or whatever, that falls to about 8.6%. All right, and the last KPI, benchmarking. Benchmarking is a term that gets thrown around an awful lot. We see a lot of people in Sharesight benchmarking their portfolios against Afterpay shares and things like that, which is just a recipe to make yourself really disappointed. And it's not a realistic alternative as well, We always advise people, again, not AFSL, but we do advise people in a roundabout way, pick something investable, right? Pick something that's realistic. Think about the S&P 500, think about the ASX 200. How are you going to access that? Is it through an ETF? Is it through a fund manager? Is it through robo-advice? Are you going to try to rebuild the index yourself? We actually have quite a few people using our software to do that stuff. They've got unlimited time, apparently. But pick something that's realistic. And again, we say use a passive or a defensive alternative. I mean, in my case, I'm 38, I've got a 4-year-old, I've got a 2-year-old, I run a business, I just bought a house, I'm really, really busy. I love investing, but I just don't have a lot of time. And so this is why I always try to have a benchmark in there. It's like, all right, if I just kind of have to give up here, put this thing on autopilot, what am I going to pick? So that's what we say. And do it on the same terms. Use the same calculation methodology, use the same amount invested, and use the same time period as well. So again, if you're looking at just the return of the ASX 200 or what it's done, on Sky Business or in the Fin, what time period are you looking at? So, in conclusion, KPI tracking metric number 1, track your performance properly. We like annualized methodology. Again, you get paid an annual salary. You think about school fees annually. You do a household budget annually. That's how we live in the world as financial human beings. We also like money-weighted returns because it mitigates the impact of cash flows in and out of the portfolio. Understand your dividend impact. That's very obvious, especially for Australian investors. Understand the impact of fees. Watch out for those hidden fees with some of these brokers. And finally, do some proper benchmarking. So thank you very much. Please consider joining us on our investment journey. Thanks.